Welcome back to Investing Talk Podcast.
Today we're looking at VIVK.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're looking at VIVK, which operates in commodity trading and midstream logistics.
Right.
And we're really framing them as a company at a critical strategic inflection point.
An inflection point.
Yeah, they're trying to shift from being a simple fixed-fee logistics provider to a scaled inventory-based commodity trading house. It's a huge change.
And what makes this so fascinating is just the sheer velocity they've hit recently.
Right.
I mean, we are not talking about slow, steady growth. We are looking at significant revenue acceleration.
Absolutely.
The Q1 2025 financials, for instance,
Yeah.
revenue surged a massive 133% year over year.
133%.
Yeah, climbing up to what, $37.3 million? And the efficiency part is kicking in too. Gross profit jumped an astounding 345%.
And that kind of operational leverage is exactly what gets investors excited.
It has to.
That Q1 data is remarkable, and it's really important context for everything that comes next. Their full year 2024 revenue was already nearly $90 million. That's up 51% from the year before.
So it's not a one-off quarter.
Not at all. This consistent, aggressive growth, it reflects really robust market demand for their core services. Oil logistics, terminaling, that sort of thing. The foundation is solid.
And that foundation, as our sources point out, is unique. It's because of their proprietary asset base.
Right, the Omega pipeline.
Exactly. They have these critical logistics and terminaling assets, including that pipeline, which gives them a genuine operational advantage.
It's not just renting space.
No, they own the pipes, they own the terminals needed to move the product, and that's both here in the U.S. and internationally in Kuwait.
And the ownership of that infrastructure is so key. It makes the logistics business sticky, provides a nice base level of recurring revenue. The biggest story this quarter, the real game changer, is their shift away from just being a toll collector.
On that infrastructure.
Yeah, to being an inventory risk taker, a trader.
Okay, so let's unpack that strategic pivot, because that changes the entire investment calculus for VIVK.
It does.
What really enabled this was the closing of a major financing package back in October of 2025, a $40 million commodity intermediation credit facility.
And we should probably take a second to explain that because it's a critical piece of jargon.
Please do.
A commodity intermediation credit facility is essentially a specialized line of credit. It acts purely as working capital.
Okay.
So it's used to quickly buy commodities, crude oil, natural gas liquids, and then immediately resell them. You act as the middleman to capture, short-term price gaps.
So it's not for building factories or R&D?
Nope. It's purely for trading. It's what allowed them to materially expand their trading capabilities, instantly.
So this facility was the fuel for their new VIVK supply and trading platform, the VST.
Exactly. It's the fuel.
And they put it to work fast.
Astonishingly fast.
Yeah.
I mean, they announced an inaugural $23 million LPG transaction almost immediately.
Wow, that's more than half the facility.
Right. It utilized over 57% of the new capacity. That single transaction is the operational proof point investors really needed to see.
It shows they could actually execute the plan.
And deploy that capital quickly, yeah.
And what's fascinating is that this huge strategic pivot, it was actually preceded by a few smaller signals of confidence from management earlier in the year.
That's a great point. Before the big credit facility, back in August and September, they were already reporting the highest level of contracted revenue in the company's history.
Reinforcing the core business.
Exactly. It showed the underlying logistics business was strong just as they were about to take on this high-risk trading pivot.
And the dividend.
Oh, crucially, yes. They also announced a special dividend payment scheduled for late October. That's a powerful signal that management is confident in their future cash generation.
Even as they take on more risk. And we should probably also mention the capital raise that happened around the same time.
We should. In October, they did a registered direct offering.
Right.
To raise about $3.5 million through common shares and some pre-funded warrants. It's just a quick way to get a liquidity injection.
So more cash, which you need for a trading business.
You definitely do. But we have to acknowledge the immediate downside of that.
Dilution.
Dilution for the existing shareholders.
And that trade-off, sacrificing a bit of ownership for that short-term cash, it brings us right to the main tension point in this whole story.
The profitability question.
Exactly. Because despite all this exciting growth, this pivot, the cash races, VIVK is still running significant, persistent net losses.
And this is the critical risk factor that the market has to weigh against all that revenue growth. The trailing net income is a loss of nearly $41 million.
Wow.
And what's maybe more concerning to a cautious investor is that those losses actually increased by over 114% from 2023.
So revenue is soaring, but the loss is growing even faster. What's causing that disconnect?
It's likely a combination of things, but sources suggest it's heavily weighted toward the investment in the new platform.
The cost of the pivot.
Exactly. When a company scales this fast and pivots into something as complex as commodity trading, there are massive front-loaded expenses.
Like what?
Think about the cost of building out the VST platform, hiring specialized traders, legal fees, financial infrastructure to manage that $40 million facility. You spend all that money before you see the profits from the trading activity.
So the market's basically waiting for the VST to start generating margins that are wide enough to cover all those investment costs.
And to do it quickly.
And this rapid scaling, coupled with the reliance on debt, it introduces other risks too, right? Beyond just the market.
Oh, for sure. They're highly reliant on volatile oil markets, which can be brutal. And the sources also flag their small employee base.
Management risk.
Big time. Rapid expansion can stretch a small team incredibly thin, creating internal risk if something goes wrong, especially in high-stakes trading.
So if we look at the technicals, the stock chart must reflect all this volatility.
It absolutely does. As of mid-November, the stock is trading around, 17 cents? But its recent range is wild, from 14 cents all the way up to almost $1.70.
That's a huge range. It feels like investors are just fundamentally unsure how to value this thing.
Precisely. And right now, the price is miles below its key long-term averages.
How far below?
Well, it's sitting far beneath the 50-day moving average, which is near 78 cents, and even further below the 200-day, which is up around 74 cents.
Oh, there's a massive gap there.
A massive gap, which suggests, significant mean reversion potential if the story solidifies.
So that gap is either a huge opportunity or a huge warning sign.
Depends on your risk appetite. But on the plus side, the momentum indicators aren't flashing any warnings just yet. The RSI is neutral, around 48.
Okay, so it's not overbought. If good news hits, it has room to run.
Plenty of room.
Which brings us to the most immediate and I think critical date on the calendar, November 20th in 2025.
Yep. The Q3 earnings release.
This feels like the moment of truth for this whole pivot.
It absolutely is. Investors need to see that first major financial disclosure after they deployed that new $40 million facility.
And they're not just looking at the top-line revenue number.
No, not at all. They need proof that the VST platform is generating real demonstrable revenue. And more importantly, that it's doing so at a respectable margin.
They need to see that the $23 million LPG deal wasn't just a one-off for show.
Exactly. They need to see it's the start of a scalable, profitable trading operation. If they can validate that, the thesis changes entirely.
So looking beyond earnings, what are the next operational catalysts?
Well, continued expansion of the VST platform. And as we get into December, you often see increased seasonal trading volumes in commodity markets around the holidays.
Right. And with a story like this, high risk, high reward, there's always market speculation swirling around. What are the juiciest rumors the sources are tracking?
The biggest one revolves around that credit facility.
A $40 million one.
Yep. If VST execution in Q3 and Q4 proves to be highly profitable, there's speculation that the lenders might agree to expand that facility even further.
Which would be huge.
Potentially exponential scaling of their trading activity.
More scale, more volume. Solves that net loss problem a lot faster.
That's the theory. There are also persistent rumors about potential M&A activity.
Oh.
Yeah, VIVK's mix of U.S. assets and that international exposure in Kuwait makes them a pretty unique target. You could see a larger energy infrastructure player wanting to partner up or just acquire them outright.
And finally, that special dividend.
Right. That's put dividends back on the table. People are wondering if that was a test run. If the cash flow from VST proves to be strong and reliable, the conversation will shift to making that dividend a regular thing.
Okay, so to summarize the investment thesis for you, our sources are, on the whole, pretty bullish. They give it an 8 out of 10 rating.
Which is high.
It's very high. The bull case rests on that explosive growth, the strategic pivot, that favorable technical setup with a huge gap to the moving averages, and the fact they have the cash now to trigger the next phase, the potential for a huge return, what some sources call multi-bagger potential. It's definitely there.
But it's entirely conditional on execution.
Entirely.
I think the summary is actually pretty simple. The path for VIVK for the next year or so will be defined entirely by the VST platform. They have the capital. The question is, can they deploy that $40 million efficiently, profitably, and repeatedly?
The high-risk, high-reward bet on management's ability to execute a really complex shift under intense scrutiny.
That's it in a nutshell.
So given that negative net income is growing just as fast as revenue, the true measure of VST's success won't just be how much volume they trade with that $40 million, but the actual net margin they achieve on every single one of those transactions. The ultimate question for you to consider is this: will the high-stakes commodity trading business generate enough profit to flip those historical losses into positive territory faster than the market currently anticipates?